Well, I think 12 to 18 months is a very interesting timeline. I think that's going to be around where the market bottoms. So I think we're in the early innings of, I know prices have come down a lot, and people are citing discounts as an exciting reason to buy today. Oh, well, this deal is 20% less than what it was worth a year ago or a year and a half ago. But unfortunately, that is at this moment in time not often enough of a discount to really justify a good buy, in our opinion.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm here with Rob Beardsley. Rob oversees acquisitions and capital markets for Lone Star Capital. He's acquired over $350 million of multifamily properties, and he's evaluated thousands of properties using his proprietary underwriting models and has sold 10,000 copies of his book, The Definitive Guide to Underwriting Multifamily Acquisitions. Rob, thanks for coming on the show today. I appreciate it. I appreciate you taking your time out.
My pleasure.
Can we start just with kind of hearing your story, your background, how you got into real estate, and then we'll kind of dive in from there.
Yeah, absolutely. So I actually grew up in a real estate family back in Silicon Valley, California. My parents ran a residential brokerage firm from home. So I was exposed to real estate at a very young age and was kind of around the business, but I didn't have a particular interest or passion around real estate. I was actually more so interested in tech because I grew up in Silicon Valley and my parents pushed me towards going and making a lot of money in a startup rather than working really hard in real estate. They thought real estate was kind of like a boring get rich slow. And my parents worked really hard for commission checks, but never really turned those commission checks into long-term wealth or equity through their real estate ventures. They focused on fix and flips and buying and selling luxury homes for their clients. So it wasn't until I was in college studying computer science that I kind of caught the real estate bug and started researching multifamily specifically, not single family. And multifamily, as you know, has a much better business model that is more conducive towards long-term wealth and cash flow, as well as more of an institutionally, it's better for scaling on an institutional level.
Sure.
So that all really resonated with me much more than what I was familiar with on the single family side. So I ended up starting my company, Lone Star Capital, with my business partner, Kent. And he was a tax attorney at the time with, full-time day job. And I was a student at university. I dropped out. He left his job and we started acquiring property together and raising capital with investors. And then fast forward about almost 6 years later to today, like you mentioned, we have nearly $500 million in assets under management, and we've scaled up to really building out that vision, which is an institutional operating platform where we can invest our own capital, invest capital on behalf of our investors, and really run a very tight ship.
Yeah, in a quick nutshell, you describe what has, I'm sure, been a lot of work and obviously a lot of success over a relatively short period of time. Interestingly, kind of coming from a real estate family background, but not the same. And you touched on some of the differences between multifamily and how what your parents were doing wasn't necessarily attractive to you, but then real estate in a different way was. And I wanted to kind of touch on what those differences were to you. You mentioned scaling. I guess from being a broker's perspective or doing fix and flips, those sorts of things are a lot more transactional, and people make good money doing it. Like, it's not necessarily a bad thing, but it doesn't necessarily push you towards a portfolio of passive income. What's your, I guess, why didn't you like what they were doing? Kind of what pushed you in the other direction?
Well, I think it's the fundamental paradigm that one comes from typically when you're investing in single family, or not even investing at all, but just like you said, working in a transactional capacity versus actually building equity. And it's all about long-term thought process and delayed gratification. And the problem that my parents were in, they were caught in that middle class trap of running their own business, having high income, but then having high expenses, and then also, not that this makes them wrong or bad, but having expensive, home and children and trying to raise a family. I mean, we're all trying to have good lives, right? So that rut, if you will, prevented them from thinking long term and thinking about, well, I can invest for tomorrow. I won't really see any money today from it. I'm actually going to take money away today in order to see more tomorrow. It's very, very difficult paradigm to get yourself into. And I remember asking my dad, oh, why don't you invest and own this rental? And he said, I can't afford to, right? I can't afford to make this investment. I need the money today. And so that's a trap that unfortunately most people find themselves in, or at least they mentally find themselves in. And it's a very difficult task to break out of it. So I was very, very fortunate to be able to stand on their shoulders and build from a very strong foundation and be able to kind of cut the line and go and have the luxury to think long term and go, you know what, I'm actually willing to work and maybe not make any money for a handful of years, and then know that it's going to compound into something much, much bigger than what otherwise would if I were to chase the money today. So I think that's the fundamental difference. I mean, at the end of the day, when you're talking about single family versus multifamily, it's just one to many. It's actually
Mhm.
quite similar, but it's more so the thought behind it and the paradigm.
Yeah. And I think that that's whether you're in real estate as a broker or doing whatever it is, that same mentality, mindset, whatever you want to say, is the same thing that like a lot of people in their jobs, they're kind of get in and they do a lot to build themselves up with success, and then they have that lifestyle creep, and it's just kind of, you get stuck in that trap that you talked about. And I think that it's very interesting to hear. I don't know, I guess in some ways maybe we all rebel against our parents, but it's kind of funny to hear that you sort of figured that out at obviously a young age. And they wanted you to go into tech and make a lot of money in tech startup, which is maybe in theory a lot riskier than what you actually did go ahead and do. But that delayed gratification and the paradigm shift of, hey, I'm going to do this, but I know in the long term this is going to work out, is something that I think, whether you're actively or passively investing, is an important shift to make. um so how would you describe, sort of the early years of getting into multifamily, and kind of, you mentioned work for a number of years without making a lot of money, and I think that's true. I can sort of echo that sentiment. Maybe talk a little bit about, how you came to grips with that, how you've managed it, and then why do you see that as being, the way to go? What, like, in what's your vision over long term?
Yeah, well, to your point that you mentioned, as far as a startup could actually be, I mean, it is very risky, much less likely to succeed. And for me, that doesn't resonate. So I am in some ways risk averse, and in some ways I'm tolerant of risk. And so the ways in which I'm risk averse is I really do like a sure thing. I don't want to invest a lot of effort into a vision and then have it not pan out. So I really look at a journey in real estate as a get rich for sure journey. And it's not a get rich quick, but it's a get rich for sure. And that resonates with me a lot. And starting young, having the luxury of time, it's a much easier proposition to buy into that
Yeah.
journey, because you have the time. So that is my thought process. To give a specific example, I remember us really struggling on our first deal to raise the capital because my business partner and I both never raised money before, and we completely underestimated how difficult it is to raise money, especially when you have no track record, and a limited network. But we figured, oh, well, we'll find a good deal and surely we'll be able to convince people to invest in a good deal. How hard would that be? But of course, we found ourselves really struggling to raise the money. And that was a trying experience to get all those no's and really struggle and have to give away a lot more piece of the pie than we had anticipated. As you can understand, people see us as first timers and they want to extract better economics if they're going to take a gamble with us. So we were giving discounts on fees and we were giving up shares of our ownership, which is all very valid. And I don't regret any of it at all. And to the contrary, actually, I remember thinking to myself, but also explicitly my dad telling me that you should be happy if you close this deal and actually have to pay money to close the deal, because it's such valuable experience and will build your track record for the future. So that was kind of the concrete example of the mindset that I was in.
Yeah. Yeah. And that's a great piece of advice, for anyone starting out. That first deal it might cost you a little bit money. You might not make any money, but like the reality is you're trying to get in the game, get the education. Essentially, it's, if you don't make money, it's because you're paying for the education, and move forward that way. And that's why it has to be a long-term vision. And I think I love that you said, I like the guaranteed thing, and then talk about real estate, because so many people outside of the space think it's this huge risk. And like those of us that are in it and have kind of realized the potential, it's like, it's exactly that. It is a get rich for sure, just slowly, right? It's just going to take time, but it's going to happen. And you just have to believe that and kind of keep going. And that's, you don't necessarily want to listen to the person who, got lucky and made a ton of money in their first 6 months or 18 months or something like that. What you want to look at is people like yourself that, you're 6 years in, now you're at almost $500 million on assets under management, like people that are doing this long term, and then starting to realize the benefits, because it is really just the velocity of money over time. And you mentioned at a young age you're able to take advantage of that and maybe not push as hard. When I talk to investors, I get super fired up when I talk to people that are young, because I know I started in my 40s, and I'm like, if I had started 20 years before that, like the advantage that you have just in the time of, or just in the factor of time, right? If we're expecting our money in these investments to go to double every 5 to 7 years, like that's 4 doublings in 20 years. So it's just kind of, I think people not understanding that the value of the time of that money invested. You wrote the book. I've read the book. I've used it. I think it's great. I think it's a really like very tactical, right? It's just like, here, I sit down with this. I've seen your underwriting model. I've used it. Like it all goes together well. What was kind of the driving force behind deciding to do that? Because I think sounds like if your background, what you went to school for was tech, then how did you get yourself, grow your expertise in underwriting and sort of develop that as something that you were an expert enough to write a book about?
Well, I somewhat stumbled into writing the book. I didn't have a master plan. What happened was, when I first got into the business, I looked around for a resource similar to it to become an expert in underwriting, and I didn't find anything. And I thought it was a bit strange to not have some sort of resource like this available in the market. So I told myself that I would set out on my journey to become an expert and build up my understanding of underwriting, which, for those listening that aren't familiar with what underwriting is, it's just the financial analysis of an acquisition. It could be real estate, could be private equity company or something. So over the couple years that I really learned and underwrote hundreds of deals to build up my expertise, that's when I turned around and actually sat down and wrote the book. And it was very easy to write because, like you said, it's very tactical, and it's just a simple, not maybe not too simple, but just a straightforward walkthrough of our underwriting process, line by line, step by step. And it filled a gap in the market that didn't previously exist, which is why it has been so much more successful than I ever anticipated. I didn't have any sale goals or anything like that, but it's been very well received and has built our network really, really well. So I'm very appreciative of that.
Mm-hmm. Yeah, and it is. I mean, definitely there was. It's interesting to me. There is no other book on underwriting. Like it's a very weird thing that there's so with books being sort of the new business card. It's odd to
Mm-hmm.
me that's the yours is the only one. Like literally, I have seen no others, and there's you know 10 books on multifamily investing, and there's 10 books on being a passive there's all this other stuff that there's multiple books on, but it really is the only one that I've seen anyway, have any knowledge of. And it is, you can sit down with it and use it as sort of almost the instruction manual for underwriting. And so I mean, it's great that you did that. um you, I think, used to do underwriting for other people. Is that correct? That was sort
Yeah.
of part of your business, I guess.
Yeah, that's right.
Yeah. And that's actually how I heard about you, from one of my mentors. I think you used to do some underwriting with her, for her. But so what do you do now? Kind of what's your focus in the business? You've grown a lot. We've talked a lot about on this podcast that you can't do everything. So what is your kind of lane? Are you still underwriting, or have you moved to more of a capital raising role, or maybe you are still doing it all? I'm just interested.
Yeah. So at this point in time, my main focus is on still overseeing the acquisitions process. But we have a great team that does the heavy lifting there. So I just spot check numbers and just look at the high level details of the underwriting. And then I'm involved in advising and overseeing and actually negotiating uh, the terms of acquisitions. And then on the capital market side, I'm also involved on the debt, because obviously we all know how critical debt is to the underwriting, to the business plan, and everything tying together. And then, of course, the big 800-pound gorilla is equity. So raising equity is a big job, and so we spend a lot of time talking with new investors, with our existing investors, talking about new deals and existing deals. So as you well know, that is a full-time job.
Yeah, for sure. That's spend a lot of time on the phone or email that way, Zoom calls, that sort of thing. Where do you see? I know nobody knows this for sure. Where do you see the next, since there's a lot of talk about this, the next 6, 12, 18 months shaking out in the market?
Well, I think 12 to 18 months is a very interesting timeline. I think that's going to be around where the market bottoms. So I think we're in the early innings of, I know prices have come down a lot, and people are citing discounts as an exciting reason to buy today. Oh, well, this deal is 20% less than what it was worth a year ago or a year and a half ago. But unfortunately, that is at this moment in time not often enough of a discount to really justify a good buy, in our opinion. So
Yeah.
we think instead that this is the very early innings of what will be much more exciting opportunity, with, unfortunately, blood in the streets starting to already trickle in. So we're starting to see deals come to market where the sellers are finally readjusting their pricing expectations to meet the market more. And that's going to really untie this bottleneck on transaction activity right now. There's very little deals getting done right now, and I think that's going to pick up over the next 12 to 18 months. And we're going to, and the reason for that is because people are kind of extending and pretending, but there's only going to be so long that people are going to be willing to wait until they finally face the music in regards to deals that have floating rate bridge loans that are maturing or have interest rate caps that are expiring. and it's going to create a capital crunch in their balance sheet, whether they're going to have to do a capital call or raise outside equity or debt in order to finance themselves, to bridge a gap, or to do a cash in refi, just because valuations are lower and will be lower, making it more difficult to refi. So yeah, I mean, I think there's going to be a lot of interesting things happening on in the market that's going to create opportunity.
Yeah, yeah, it makes a lot of sense. I mean, that's kind of what I think everybody's seeing at this point is there are going to be. I mean, it, as you mentioned, it really just comes down to the debt. You know, depends on where you're positioned with. If you have, you know, fixed rate debt with plenty of time to ride it out, you should be fine. But as you said, that, you know, rate caps maturing, bridge debt maturing, all of that is going to cause some headaches along the way. So what about for you in Lone Star Capital? What is, you know, kind of how do you see the future? What are your goals? Where are you looking to head?
Well, thankfully, our portfolio is well positioned, all things considered, to weather the coming storm and deal with already the interest rate increase challenges that have been occurring. So we're, because of our existing portfolio being relatively well positioned, we do have the luxury to turn our attention to opportunity. Whereas a lot of groups, unfortunately, are going to end up finding themselves stuck in portfolio and legacy challenges, and that's going to prevent them from being able to be aggressive and take advantage. So we're gearing up for acquisitions. We do recognize that it is a harder environment today to raise capital in, specifically equity. And I think that's only going to get more exacerbated. So I'm anticipating that we're going to have to, like right now, we kind of joke and say that right now we're working twice as hard to raise half as much equity. And I think that it's probably going to double. We're going to work 4 times as hard to raise half as much or something, right? So we have to be prepared for that. And however, I think the smart money, which thankfully we have a lot of investors in our network that I would call smart money and are large investors that are capitalized and have the experience and the wherewithal to take advantage of market dislocation. So I think we will be able to raise the equity needed to buy great deals over the next 12 to 18 months. And the thing that's tricky about our business is, you know, sure, we have our internal goals. So for example, next year, we'd like to acquire 300 million in assets. However, that is largely dictated by the market. We have to take what the defense is giving us, and forcing a deal is the worst deal, right? I always say that the best deal you do is the one you don't do, right? Because no matter how good of a deal you can do, the best thing you can do is actually avoiding a bad one, because we all in this business work so hard to build our reputations and to protect them. And unfortunately, only one moment or one deal can really unravel that, all that effort and brand equity, personal equity. So that is that's the goal for the next 12 months or so.
Yeah, it's a fantastic point. I mean, you know, these are investors that, you know, they've worked hard for their capital that they're trusting you with, and ultimately what you want is to have them have, you know, an excellent experience and continue to invest with you in the future. So as you know, again, it goes back to that delayed gratification or the long-term picture of all this, where it's like if you have a goal of 300 million in acquisitions and you don't get there because those opportunities aren't there, okay, right? That you just keep, you know, kind of carry it forward. That'll mean that you're better positioned to do that in the future. So I think it's a great outlook. Well, that's great, Rob. Let me switch gears here. I want to ask you the questions I ask every guest. First one being, based on the name of the show, what is your why? You know, kind of what drives you forward? We've heard a bit of your story. You're obviously very successful already. What kind of keeps pushing you?
I think this sounds, I don't want to, I don't think this is too cheesy, but I think that for me, I have this natural drive of the enjoyment is the journey, and setting goals and pursuing them is really the motivating factor or the purpose. to life. So I don't want to necessarily, I do want to achieve my goals, but I don't want to achieve my goals such that I have arrived, right? I always say that a fool is someone who achieves their goals, because you should just be continually re-raising the bar and be in constant pursuit, because apathy or complacency is very, um, very unproductive, and that doesn't produce a lot of meaningfulness or joy and happiness and whatnot. It's actually really interesting. I had this unique thought not too long ago about humility, and think like, because I thought to myself, what is the opposite of complacency? And it's actually humility. And I really love this idea because humility kind of ties everything together. Because if you're humble, you're not necessarily, you don't think too much of your current position, so that motivates you to strive for more. But then also, being humble is a very just good disposition to be in, to receive, right? Because if you're not humble, we all know how that can end up.
Yeah.
So I really like, I really appreciate and value humility.
Yeah, I think that's great. I think those are great points. I'm sure I'm going to get this a little bit wrong, but there was this clip from Alex Hermosi talking about just basically exactly what you just talked about in terms of, resetting the goals and kind of always pushing for more. And he was like, so many people set their goals and they want to get to this certain point. But if you think about things like uh, marriage and business, and like, you don't want those to end, right? You don't. So the goal shouldn't be finishing. The goal is to continue doing well at them. So it's kind of like keeping that, just like you said, like keeping, you should never reach that goal, because once you get close, you're like, well, I can do better than that. So I just keep moving that up, and then maintaining humility about it. I think is a fantastic perspective on it. So I love that. Tell us something about yourself that isn't common knowledge, special skill, a hobby, anything you're comfortable sharing, just to let people know you better.
A couple things come to mind. It's a little bit, I don't know, bittersweet, but I was classically trained to play piano. So I used to be quite good on the piano, but unfortunately, I don't really play at all, which is sad. But hopefully, maybe by saying this, it kind of nags me a little bit to get there. So yeah, we'll see. I do kind of have this push that maybe I should start playing again. And another push is I actually grew up speaking Russian. So my mom is from Moscow and she moved to California when she was 21. So growing up in a three-generation household, I spoke predominantly Russian. And then after going to first grade and just American school, I stopped speaking Russian as much and forgot how to read and write. So one of my goals actually is to get back on that and relearn how to read and write, and also improve my speaking, which thankfully has been happening a lot because I've been speaking with my uncle about watches. So he's been in the watch business for 40 years, and which kind of goes back to my family's heritage a bit in Russia. And so for those that also, want to get to know me better, watches are a big passion of mine. So I spent a lot of time in kind of the watch world as far as collecting and working on kind of some fun projects on that side of things. So talking a lot about watches in Russian.
That's awesome. This is, well, first of all, I want to learn to play piano, and I'm sure if you were classically trained, you could pick it right back up if you wanted to. That's all. That's like, it's a funny story. We have a piano. Nobody in my house can play it, but I so badly want to learn how to play that there was this school was having a sale, and I was like, all the proceeds went to charity. I'm like, I'm getting us a piano. So we have a piano, and someday I will learn to play it. But also, I'm sure I am not good at it anymore. But I took Russian in high school. That was my language for whatever reason. We were like the one high school that had a Russian teacher as one of the options. So that's very funny. But I think those like having had those skills at a young age, I think it'd be very easy to sort of pick them back up. And then speaking with your uncle, and that's great. I love it. When people hear this and they want to reach out to you, what's the best way to get in touch?
Yeah, the best way to learn more and get in touch is to go to our website. That's lscre.com. That just stands for Lone Star Capital Real Estate. So head over to lscre.com to learn more about what we have going on. And if you want to get in touch with me, there's a form on the website to get in touch. And if you want to speak to me specifically, I'm very active on LinkedIn. So you can connect with me on LinkedIn, and I post daily kind of snippets from our podcast and whatever else is going on with us.
And we'll put all that in the show notes. Final question for you, Rob. What piece of advice would you give to someone who wants to get started in real estate? They hear this, they hear your story, they're interested. What would you tell them to kind of get them going?
Yeah, I'm going to tie it back into our discussion about the first deal and kind of having patience and stuff like that, seeing the bigger picture. What happens for most people when they discover the strategy and the paradigm and everything, they get very excited and they want to rush and do their first deal ASAP. And while I agree that speed is important and getting your first deal is critical, like we talked about, because after you get that first deal, you're over that hump and you're no longer a first timer, and you can then build your track record. However, you do want to be not necessarily patient, but you want to be very protective of your reputation, of your capital, of your effort. So you want to make sure that the first deal you do is right, and you don't rush and do the first deal that you see or partner with the first person that you meet. You want to take your time to really learn. And then it's all about people. So you need to really learn to be patient and vet who your potential partners are before you jump into business.
Yeah, I think that's great. The urgency, but don't rush it. You want to make smart decisions. Well, Rob, this was awesome. Thank you so much for taking the time out today. I enjoyed this. I think people will get a lot out of it, and definitely will have in the show notes so they can connect with you. But I appreciate you taking the time out. Thank you very much.
My pleasure. It was a great show. I enjoyed it.
Awesome. And folks listening, I know you're going to get a lot of value out of hearing from Rob Beardsley today. Please like, rate, and review the show so we can get more great guests like him. And thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?